Can you imagine an economy where the middle class is the same size of the US, Germany, UK, France, Italy, and Spain all combined? Could you imagine with the global retailers that would want to get a piece of that, investors as well? Well, that economy is actually a possibility by 2031, and that economy with a middle class of that size could be India. Hello everybody, my name's Jeff. Welcome to my YouTube channel. I've been working in the financial markets for around 20 years now, and over that time I've gained an awful lot of knowledge, seen a lot of good things, a lot of good trades, learned a lot about the financial markets overall, and I want to start passing off some of that knowledge to people like you. So if you want to learn more about saving, investing, growing wealth, what's happening in stock markets or Forex markets, stock options, all of these products, then subscribe to my channel and learn more, because I've got a lot more videos coming that's going to help you get up to speed and achieve your financial goals. By the way, this video is not financial advice, and neither are any of my other videos for that matter. All I'm trying to do is pass off the knowledge that I've gained over the last 20 years or so and give it to you to help you understand the markets and achieve your goals, savings, investing, and building wealth. So please don't take this as financial advice. If you need financial advice, then seek out a qualified financial advisor. And when you invest in the stock market or any other market for that matter, any other type of investing, your capital can be at risk. So just be aware of that, and let's get on with the video. Okay, so I mentioned India in my introduction. I love India. I've been there twice in my lifetime, and I hope to go back many more times. It's an absolutely fascinating country. Amazing people, wonderful food, such a diversity there. I highly recommend it. If you ever want to go to India, please take a trip and see it. In today's video, we're not going to be talking about all those wonderful things. We're going to focus more on the Indian economy because it's quickly becoming an absolute powerhouse. So the Indian stock market has been in the news a lot over the last few weeks, and this is mainly due to the elections that took place. You may remember when the exit polls were released, the Nifty 50, which is the 50 largest companies on the Indian Stock Exchange, it rocketed higher by around 5%. But that came all back the next day when some reports came out that maybe it wasn't the case that Modi would command a majority. And this got me thinking about the Indian stock market, and I thought it was a good time to take a little bit of a deep dive into the Indian economy and the stock market overall. So one of the main drivers of the Indian economy, like all economies, is GDP, gross domestic product. And India's got a very high one of around 6.8%. That's real GDP, kind of after adjusted for inflation. This is not that uncommon for major emerging markets like India. We saw this with China for many, many years as well. But this is one thing to look at, and it's very important because when an economy is growing at these growth rates of 6.8% right now, and by the way, the IMF is projecting this to continue over the next few years, then you're bound to see an increase in the standard of living, an increase in wages, and a growing economy. In addition to GDP, another thing that India is seeing right now is a huge population increase. It's actually recently overtaken China as the most populous country on earth. And this is going to have an effect on the growth rates as well. In addition to a growing population, it's reported that around 50% of India's population is under the age of 30. This is a very important demographic because as these people grow older, get into jobs that are higher and higher paying, they are going to start consuming more and more as they enter through the middle classes. Many economies are actually battling with an aging population, and this presents a whole lot more problems. So India's got a fantastic demographic outlook. Another key driver of India growth recently in the last few years is the geopolitics around the US and China. As we know, there's been a lot of problems there in terms of tariffs, trade wars, and things like this. And so a lot of companies around the world, these huge, multinationals, have realized they can't really have so much concentration of their manufacturing and their supply chains based in China only. It's just too risky with everything's going on. So a lot of them have looked for replacements, or at least to diversify a little bit in their supply chains, and India has picked up an awful lot of that business. Another key factor that's driving India's growth and potential over the next few years is it's got a booming consumer spending economy. That's right. Whereas other economies depend an awful lot on manufacturing, particularly in emerging markets like India, India instead has got a growing consumer spending economy. And this is happening because more and more people are entering the middle classes. And once they enter the middle classes, they want to spend money. Electrical goods, traveling abroad, upgraded smartphones, you name it, people want to cash in on their newfound wealth. There was a recent survey by the IC in India which says that at the moment there's around 91 million households that are considered middle class. But by 2031, that number is expected to go up to 165 million households in the middle class. That's a phenomenal number. So as these middle classes grow, the middle class households get up to 165 million by 2031, what you're going to have is a lot of global retailers and other companies from around the world. They're going to want to invest, get in there and capture some of this spending. That's just how it works. Look at Apple. They opened their first flagship Apple store in India in 2023. This is an early sign of how they're investing into India, and maybe you should too. Okay, so we've seen India benefit hugely from geopolitics in and around China and the US. We've seen a booming consumer spending with an increase in the middle classes. We've also seen a huge population growth to now be the most populous country with a very favorable demographic where 50% of that population is under the age of 30. So now let's take a look at how a retail investor, somebody like you or I, how would we get exposure to India? We see how Apple and Walmart have done it by going in and opening up their businesses or buying a local business there. But how would people like you and I do it? Well, let's take a look at the stock market in India and see if we can get an idea on how to do this. Okay, so like investing in many different countries in the world, there's a few different ways that you can get exposure to the stock market. Number one is to pick individual company stocks. Now, this is very complicated if you're not a resident of India. So if you're in the US or UK, Europe, you're not really going to be able to buy listed companies on the actual Mumbai Stock Exchange, for example. But you can do the ADRs. Now, what are ADRs? Well, they really just stand for American Depository Receipts. And what they really are is overseas companies, non-US, for example, that want to list their shares on the US stock market. They can do so by issuing an American Depository Receipt. So the stock will trade in US dollars on the main exchange like New York or NASDAQ, and you can actually buy shares in these companies just like anybody else. So if you want to buy some individual stocks and names in India that you like and you're willing to put in the work of reviewing financial statements and do your own analysis, then ADRs could be a way for you to get exposure to companies, the major companies that are based out of India, but whose shares trade on the US exchanges. So if you're not interested in doing your own analysis, going through financial statements, and you're a little bit worried about diversifying, and you want more diversification, take a little bit of risk off, particularly because it's an emerging market, then perhaps an exchange traded fund is the way to go. I've mentioned ETFs a lot on this channel, but for good reason. They're very easy. You can buy them with one transaction, and it'll give you exposure to sometimes, 200-300 companies. So it's a good way to do this. So let me show you the process that I would go through if I was thinking about investing in a market like India, and I'm not invested there now, but I may do. This is the process that I would go through to try and find some ETFs that would give me exposure to the things I want in the Indian stock market. So if I wanted to search some ETFs to get some inspiration, funds that I could look at to invest into India, then how would I do that? Well, just open up a normal browser, whatever browser you use, do a quick search on an ETF screener, hit enter and scroll down, and I find the first two of these organic kind of search results, Just ETF and ETF Database, the best ones to use. Just ETF is primarily for UK and European listed funds, whereas the ETF Database is primarily for US listed. So if I was looking for something that was in the UK, I would just click on the Just ETF link, and I come to the default page, just stick India in there, and we will get a list of funds that have India in the name, and they will be sorted by the actual fund size. So the largest fund, around £3.7 billion worth, is in iShares MSCI India ETF. And then below that, we've got the Franklin FTSE India ETF as well, and then some other ones. But this is everything with India in the title. You can see the costs as well, the total expense ratio, the returns, and then you'll see distribution. So accumulating, it just means that the dividend would be paid back into the fund, so you wouldn't receive it in your account. It'll be adjusted in the ETF price. And then the replication is how they actually go about replicating the underlying securities in this fund. And optimized sampling, it means they just take a sample of the actual stocks listed, and they basically try and optimize that so that their fund returns the same as the underlying index.
My preference personally is full replication, and that means where they'll actually physically go into the stock exchange and buy those stocks to include in the fund. So that's my preference. So this one here I like. It's accumulating again, so the dividend would be paid through the price of the fund as opposed to receiving it, but it's got a lower total expense ratio. So if we just open up a new tab on this one and we go in here, we'll get a lot more information in regards to this ETF. And what you really want to do, I think, is you want to get into these two documents as well, the key information document and then the fact sheet. So I start with the fact sheet. I want you to have a look in here. You'll get all kinds of information on this particular fund, okay? Again, the total expense ratio, you'll see more in the way of returns. So average annual returns over the last 5 years, 11.68 versus 13.99 here for the fund itself. And you'll also get some valuations, price to earnings multiple of 25 times. So it's around the same as the S&P 500. So a little bit on the expensive side for sure. 229 stocks are part of this ETF. Okay. And then if you want to get the ticker information, so you can look it up on your investment platform, then you will see that here along with all the different exchanges that are listed. So if you want a pound sterling one, if you're in the UK, then FRIN, or if you wanted a US dollar, you could do this one, FLXI, for example. Okay, so that's one way to do it. And then the other way, if you're kind of primarily in the US and you want funds that are listed in the US, then you could just go to the ETF database here and then scroll down. We're looking for an equity fund. And what I will do is sort this by region, in which case we will just dig out India in here. Okay, so we click on that, and now we get all the funds listed, equity funds for India here, again sorted by assets in the fund. So this one's got over 10 billion on it, with all the different information. There's the Franklin India ETF FLIN, so I could click on that again and have more information. There's a small cap as well if you wanted some small cap exposure. So this is a great place to look. If you click on that, then you'll get more information here as well, and you'll be able to access into the fact sheet through this. Okay, so that's a couple of tools that I use to do some research on ETFs when I'm looking to invest in a new market.
Okay, so we've seen individual stocks, we've seen in ETFs that you can use to invest in India. There's another way to do this. It's called actively managed funds, like mutual funds, for example, or investment trusts, which are similar and they trade on the London Stock Exchange. And with a mutual fund or an investment trust, what you really have there is a professional money manager, somebody who's typically on the ground in a place like India, working for a major investment firm, and they spend their time picking through company financial statements, doing their due diligence on companies there, and they are the ones that are picking stocks in companies to be part of the fund that you invest in. So what you're really doing is you're just letting somebody else do the heavy lifting and all of the work of trying to identify the best companies. So it's another way that you can get exposure to the Indian stock market, but without doing any of the, the analysis that you would need to do to pick your own stocks. The advantage to this is obviously it saves you an awful lot of time because someone else is doing the hard work. But they are a bit more expensive than you would find on, say, an ETF or if you're just picking your own stocks yourself. So actively managed funds can be more expensive, and also they're not always proven to outperform the ETFs, the indexes themselves. So it's something you need to weigh up if you're considering investing in India. But for emerging markets, some people would say it is better to employ a professional fund manager because, investing in these markets, it is a little bit different than investing in say, Europe or the US, Canada, or Australia. There's corporate governance issues, for example. So having a professional on the ground might be useful and worth the money in these cases. There are plenty of mutual funds or investment trusts that you can find that will give you exposure to all sorts of markets around the world, and India being one of them. So have a look at those, look at the returns, but also focus on the costs. Okay, but if you find a fund and it has not outperformed the actual index or the ETF you're looking at, then really, why would you pay the extra fee? Okay, so we've now seen the various ways to invest in the Indian stock market. So here's what you want to think about as well to reduce the risk. If you have a big chunk of money you're thinking of investing, then rather than invest that all in one go, maybe you want to consider dividing that up over the next 6, 12, or 24 months and just putting a little bit in each month. This will reduce the risk of there being a big sell-off immediately after you put your money in the market. So if you don't have a huge lump sum of money to invest in any one go, no problem at all. You can just invest a little bit of your money every month. And as I've said many times on this channel before, automatic investment month in and month out is a great way to go. So don't worry about it. Just start with what you can afford every month and have it invested into your favorite ETF or mutual fund. So that's my introduction into the Indian stock market and things you can do to get exposure to the market yourself. To me, at the moment, India feels an awful lot like China did maybe 20 years ago. The headlines, the stories, they're all very similar. I didn't invest in China 20 years ago, and I certainly wish I did. But now there could be another opportunity here for a long-term investor to invest in India. But the key to investing, all types of investing, but particularly in emerging markets, is to think long-term. You want to think about this in terms of where India will be in their economy in the next 10 or 20 years. Don't worry so much about where they're going to be in the next 6 months or next year. It's going to be up and down, and truthfully, nobody knows in the short term. But in the long term, where do you think that economy is going to be? And with the growth rates we've seen, we would expect it to be a lot bigger than it is even now. So that's my video on the Indian stock market. If you liked the video, why not subscribe to my channel? I'll have more videos like this coming, so hit the subscribe button and leave me a comment. Let me know what you thought of the video and also any other ideas or any other topics you would like me to cover in investing and trading in the financial markets. If you have a friend that you think might benefit from this information, then why not share the video with them so they can learn as well. Thanks for watching, everyone, and we'll see you in the next one.